Here's our housing market model for the Denver area. This particular graph shows supply of housing in the blue line. As we mentioned earlier, you can see how slowly the supply grows. Supply is very constrained in the 2010 out to the 2014 time period. As we saw earlier, we're adding far fewer homes than we added even back in 1990. So there's a relative undersupply here, especially considering growth in population and some of the demographic changes that are taking place. The green line is demand for housing, and this ties directly back to employment. This particular green line tends to be under the supply during periods of recession and over the blue line during periods of strong job growth. You can see as the economy grew quite rapidly in this area in 1999, year 2000, the demand for housing accelerates above the blue line and only returns under the blue line during the 2001, 2002, 2003 time period when we were having a little bit of post-dot-com hangover. Unlike many areas, the green line for demand for housing doesn't really get away from the supply line in 06 and 07, 08. So Denver has by and large missed this huge housing market bubble that's evident across most all of the other Western markets. As we see going into the forecast period, the demand is below the line again, below the supply, as a function of unemployment through the recession. Put another way, as of 2010, the supply of housing is too big for the employment market. There's too many houses for the number of people employed because there's such high unemployment and so many people out of work. You can see this starts to correct itself over the 5-year forecast period, and again by 2013 we're starting to come back into sync, and the demand for housing will rise as confidence returns and people are once again more gainfully employed. This is the same concept shown another way against a zero equilibrium line. The periods with below the line are periods where the market is overbuilt. Jobs are generally weak in those periods, employment is weak, unemployment is rising. Recessions are doing what recessions do. They're forcing capital investment out of underperforming industries and into industries that offer higher returns. On the other side, on the upper side of the line, the underbuilt market, the supply can't react quick enough. So when employment conditions are good, the market becomes overbuilt fairly quickly. You can see it suffers or enjoys maybe a sustained period of overbuilding and underbuilding, often lasting 4 or 5 years, while the employment situation oscillates back and forth. This particular graph shows housing valuation. The green line is the supportable median home price. Now that's the relationship of local incomes with interest rates factored in. So when rates are down, this line comes up and vice versa. The blue line is the historical median home price recorded at the county recorders and reported back to us. During most time periods, these lines correlate pretty strongly. There's periods where the employment grows too quickly and gets a little bit out of whack, and vice versa, but not typically too often. Then we come to 2009, and we've got the median home price dropping quite quickly, but the supportable price rising very quickly. That's because, again, of the government effectively lowering mortgage interest rates back in 2008. Now the local household incomes can support a much larger, more expensive house at the same time that the median house price is coming down. People are losing their homes and the economy's losing jobs, so prices come down housing-wise. So the gap between these two that you can see in 2010, 2011 is a condition of undervaluation. Those lines are separated by as big a gap as we've seen, and it really presents good opportunity to buy a home if you think you can stay there. One of the ways we've seen this manifest itself is adult support, parental support for buying homes for their kids, post-college students, early marrieds, this sort of thing. Many of these younger households are bringing down payments and other forms of support from their parents. Their parents have been around and they've seen the magnitude of the undervaluation. They recognize the magnitude of the undervaluation. They see opportunities to buy in good neighborhoods close to employment in good housing prototypes that will hold their value over time. Again, another metric for our over and under valuation. You can see the time periods and the dollar amounts shown to the left. Usually the dollar amounts are fairly constrained. The market reacts fairly quickly. But now, with the sudden change in mortgage interest rates, the market can't react supply-wise that quickly. So the undervaluation is pretty magnified, pretty profound in 2008 and 2009. Gradually that will correct and come back to normal over the forecast period, and by 2013, 2014, we'll be back to a closer to equilibrium state. But the undervaluation is a tremendous opportunity in the market now that's just not really recognized because of job losses and weak economic conditions. Here's price trends shown for the larger Denver Aurora MSA. As you can see, prices peaked out in 2006. That's pretty similar to many markets in the West. Varies a little bit from year to year, but not that much in most places. By 2010, we're down from 249 to 223, somewhere between year 2000, year 2001, year 2002 prices. So we've gone 9, 10, 11 years and haven't really put anything into the median price here. We're gradually going to get some appreciation, a return towards long-term appreciation trends in this market over the forecast year period, particularly once we start to see job growth in a little greater magnitude and a little stronger force. Here's year-over-year price changes in this particular market area. You can see from 1991 all the way really to about 2005 or 2006, this market enjoyed upper single-digit appreciation year over year with relatively few setbacks, even in the 2001, 2002, 2003 era, the dot-com blow-up, if you will. Appreciation was fairly steady. Only in 2007, 2008 do we start to experience quite a bit of downward pressure. Only to start to rebound here in 09, 010 a little bit. 1.7, 1.6, those aren't big numbers. You might consider that a mean reversion, but still it's the sign of a trough. It's a sign of a plateau. It's a sign that we've are setting a bottom, which is going to be much more apparent in close-in neighborhoods, in neighborhoods that are close to employment, much slower to manifest itself in outlying areas. But over the forecast period, we'll start to pick up in appreciation at a little bit better rates in the out years.